Welcome back, everybody, to the weekly market analysis for the week ending November 3rd, 2023. And boy, did the markets go boom this week to a pretty unprecedented level, at least in recent years. We'll talk about it all in just a moment. But first, don't forget to hit the like button and subscribe to the channel. You can also find me on Twitter at Mr. J. Thomason, or you can follow my weekly newsletter at befinanciallyfree.substack.com. And boy, this kind of caught me by surprise too. I think it caught honestly everybody by surprise. So and there's a part of you that hindsight is always 20/20. There's a part of you that says, we should have seen it coming. So what were the signs for the boom? So let me go really quick and look at one thing. One of the things I keep track of on a weekly basis is the AAII Investor Sentiment Survey. Last week it came in at this bull-bear spread came at a 13th percentile, which was pretty low. And you had the bearish sentiment up in the 88th percentile, and that was one sign that investors were pretty bearish. And so that's one thing that I wanted to mention. One of the things that we've been keeping track of is the flows. I do this in my weekly newsletter, and you can see from the orange bars, pretty much every single asset class, equities and bonds, and then commodities have all been pretty significantly down. And so there's been, essentially what this tells you is that there's been a lot of puking of mutual fund and ETFs. So that was a sign too. If you come back to the charts here, one of the things that I keep track of is the stocks trading above their 50-day moving average, and I should turn that off just for a moment. There we go. And one of the things about that we see is that, just 5 straight days of green, seeing stocks advance. So one of the things from last week, I don't know if you can see it on my screen, but this red candle here, this Friday, from last Friday, October 27th, this candle came in and actually wicked below the 10 line, which is the extreme line, and closed just slightly above at 1033. And I actually talked about this last week in the video, that I wasn't really sure what to make of it, that I wasn't sure if it was worth jumping in on because it didn't close below the 10 level. But I've back tested this, and whenever this thing falls below the 10 level, really on any basis, but I was obviously looking for it to close below, just given how risky things were looking going into next week. What I had said last week, and I want to reiterate, I said this I want to say 3 or 4 weeks ago, back in early October when it had closed below the 10 line previously, and it has an 83% win rate, or hit rate, win rate, when you take trades when this thing hits the 10 line. And so, that was a sign, obviously. Another thing that I watch is the high beta to low beta ratio. And you saw on Friday last week, you saw a reversal signal, which is the green triangle to the upside. Now, this doesn't always mean that it will reverse, but often the signal is stronger when it's signaling a green bullish reversal pattern, or a reversal signal. So you can see here, back in late September, we had a bullish reversal to the upside on this ratio here. We had it back in December, right as the NASDAQ was making lows near its October lows from last year, before it obviously rocketed up into the beginning of 2023. So it can be a pretty powerful signal. So that was a signal that should have been a sign. Another thing that I watch is the ratio between junk bonds versus SHY, which these are both ETFs that track one, junk bonds, and then shorter duration treasury notes. It's a pretty good cross, and we had gotten a reversal signal at the beginning of last week, and we kind of closed up on the week, and while it was still down, and obviously it was in, you see the red flag here, that means it was in bearish tide. One of the indicators that I watch is whether or not this is in bearish tide or not. And in bearish tide, that's usually not a good sign, but it has, it was down near levels associated with reversals to the upside. So that's a sign too that it was a little bit overextended as well. And so all of those things together, should have been something of a signal. I mean, we also talked about this last week. One of the things I mentioned was when you have a VIX that's up on Friday for 3 weeks in a row, Monday would have been a big crush in the VIX. And I mean, look at this on a weekly chart. It's hysterical. Look at that. Look at that candle on the weekly chart. That's pretty amazing. So that was something, that was a pattern to watch. And then the other thing that I've thought more and more about that I wanted to take note of is the fact that on Friday, so basically ever since 2020 and maybe even ever since 2009, the lows in March 2009 after the great financial crisis, tech has largely been the leaders of every rally, every bull market, whatever the case may be, typically leads to the upside. So one of the things that happened last week that I thought about but didn't take it seriously enough was that on Friday we had S&Ps closing down almost 0.5%, but the NASDAQ closed up 0.5%. And that was the S&P and NASDAQ are pretty correlated, but obviously the NASDAQ tends to, when it's bullish, outperform. And that should have been a sign that there was a positive divergence in such a way that would lead equities to the upside. So those are things that were signs, but obviously nothing is certain. And definitely the sentiment was not so good because on S&P, we had closed last week down, 4137, and people had been talking about 4200 being the spot to buy, and price blew through it. And so once it blew through that, a lot of people had kind of flipped bearish, thinking, wow, we're going to go much lower. And, obviously we've completely reversed that. One of the other dynamics at play is the positioning. And last week, one of the things I talked about in my newsletter was that the positioning actually got longer in the S&P 500. And I don't quite today, as of the time of recording this, have my positioning data updated, but I'm interested in seeing if the positioning got longer or shorter here on S&P, because that'll be a pretty important tell as to what's going on. But one of the things that has been apparent for basically all of 2023 is that investor positioning, at least via the futures markets, according to the COT data, have been really underpositioned in equities. And a lot of that had to do with the recession forecast that people had coming into 2023. And so all I would say on that is that, because we're getting into November, there's seasonality that people are talking about. It's pretty amazing. The gain from the close last Friday to now on S&P was 5.76%. On the NASDAQ, from the close last week, NASDAQ's up 6.4%. The Russell, off the close from last week, the Russell is up 7.45%. So this is pretty incredible movement that's already happened. And the fear now, or not the fear, but if you're short or with a bearish bias, then the threat right now, or the risk right now, is that everybody who's been underweight is going to look at this price action and be worried about, people who have been on the short side or under position, looking for downside to be able to buy lower and whatnot. People are, that could lead people to performance chase into the end of the year. And there's risk that this could just run away. So having said all of that, I want to look at a couple of things, a couple of the levels on equities and maybe a few other tidbits here. So first of all, a couple things on the S&P. I left this up here before I started recording because I thought about deleting it, but I wanted to just show you. I was watching these two trend lines, descending trend lines, And one of the things that I will do is on a price bounce, when price action is going towards the downside, and you can do this to the upside too, but so here you made a lower low and then bounced and made a lower high. So then what I ended up doing is making this trend line here. Well, that trend line broke, and we closed above it. So I'm going to leave the trend line here. If price makes a higher high, then it will get deleted. And then obviously the next place that we're going to be watching, the next level of significance is going to be right around here. We'll see what happens when and if price gets to that. So you're going to want to watch the 44.10 level first, because that will be the the closing highs of the mid-October bounce, and then just above that the descending trend line. So we'll want to be watching that over the next week or two to just see what happens. One of the things I want to point out is that the S&P 500 is in bearish tide, and one of the things that is really hard, usually when it's a trending market, it's a lot easier to do this, but let me just show you some examples. So we had the bear market here in 2022, and then as we came into this year, we got a bullish tide cross, but price was retreating down into that cross. And what you ended up seeing is price come back down far enough that it caused a bearish recross, and then price came back up and caused a new bullish cross. And all that is to say is that when the market is trending sideways, these signals are not as good. So I would say like the direction right here is pretty uncertain. One thing I want to say, I guess on the bullish side, I feel like I've already made the case on the bullish side that investors are still relatively under positioned. If you were to pull up once again the AAII sentiment, sentiment actually got more bearish and less bullish. So you can see bullish reading, we're in the 9th percentile. In the spread between bulls and bears is in the 4th percentile, and bearish sentiment is 96th percentile. And so there's plenty of sentiment fuel, at least, to send this thing higher. As of last week, positioning, particularly in the Dow, is extremely bearish, but that's only a small percentage of the overall equity futures market, so I'm not sure what to make of that. But so we've got the bullish case already made. But in terms of the bearish case, I would say a couple of things. That if this market is going to roll over and continue making lower lows, then technically, according to the tide indicator, this is the best place to short, or to get out if you have been long, or maybe to hedge if you are long. Now, shorting is really hard. It's not super efficient. It's not a super efficient way to make money, at least in equities, which tend to have upward drift. But and obviously, if you were short here, you got your face ripped off. So that's something to be aware of as far as to the short side. But so at least as far as the bearish argument goes, being in bearish tide and price being right here, right above the control line, is usually a prime place to place a short. But the problem is that all of the downside momentum is almost entirely gone, and the price is just going kind of sideways according to the lines here, and so that's a very risky spot. So it could just keep going, but we'll see what happens. Because the other thing, if you want to look at this, like if I pull up, let's see, rate of change. I'm doing this in real time, so I apologize about that. But if you look at the rate of change, then one thing that I think is kind of interesting is if you go to a weekly chart, it's been a while since we've had this level of rate of change. So again, on the S&P, up 5.76%, higher than November 2022. I think the last time the rate of change for the week was higher was in June 2022. And what's notable about that is that was at the beginning of the bear market rally that took place, the summer 2022 rally. And so I would mention that. But the point that I'm making, the one that I want to make is this could be the start of the next like rally to the upside. I'm not sure if we'll make higher highs. I don't know. Nobody really knows. But I will say this, when you go back and you look across price history, then it's in the bearish trends or in the bear markets where you actually see that substantial rate of change, at least to the upside. The only exception that I have found so far has been as far as like higher levels of price action, or I'm sorry, higher rate of change when it wasn't a bear market was back in November 2020 and then early April 2020, at least in the last few years. And outside of that, you have to go back pretty dang far to find a place where the rate of change was higher than what it was this week in a bullish trend or in a bull market, or like coming out of the bottom of a correction. And so I feel like the odds are not good. If we're thinking probabilities, the odds that price continues to the upside, at least in the near term, are not great. I mean, it doesn't mean that price has to go down or crash down, but price could go sideways for a little bit. I'm just saying near term over the next week, it's not necessarily super favorable to like continued explosive moves to the upside. And on that stuff, part of what happened was, Fed Chair Powell spoke on Wednesday, and the market took his comments about rate hikes and the economy and stuff like that as being very dovish. So that was supportive. We had multiple data points come in this week that showed softening of the economy, but not too much softening apparently in the economy to the point where the markets are looking at, it's so funny, markets are looking at the Fed pausing and pivoting potentially. We're at the point now where 100 basis points of rate cuts are getting priced in next week. And that's what you're seeing, in the bond market too. The yield has just come off substantially, like especially since Wednesday. So, looking on the week, the 10 years down 26.5 basis points. The 2 years down 16 basis points. Long duration treasuries, 20 years down almost 27 basis points. The 30 years down almost 25 basis points. So investors have essentially decided that this is the spot. And one of the things that I would say on the bond side is, and I don't know if I can't remember if I did this on the YouTube here or if it was in my newsletter, but back October 2nd of just last month, we had a bullish tide cross, and one of the things that I brought up was that usually the bullish tide cross after an inversion over the course of the history of the time series has meant that a recession on a median and average basis was about 3.5 months away, and that usually 1 month after that bullish tide cross took place was the time to buy TLT. Well, that time, 1 month later, was yesterday. And so is this going to be, is TLT going to shine here? So obviously we got a huge move up, kind of sold down throughout the day, but TLT was up, almost 4% on the week. So pretty admirable. However, it still is not back up to its levels that it was at, that it fell down to in October of last year. So here we are on the daily chart. So there's still, a lot of stuff to work on. We haven't even made it back to the tide line. So could it be premature? Possibly. We'll have to look forward to the CPI in I think it's in 2 weeks. I think it's Tuesday the 14th. I'm not really sure about that off the top of my head, but we'll have to look and see if inflation is going to behave. Because right now the markets are assuming that the labor market's cooling, and then inflation is falling. And so if the inflation print is friendly, then I assume that asset markets will continue to appreciate. And if it doesn't cooperate, then I suspect that we'll get a sell down in asset markets from there. So I wanted to mention that. I think I'll cut it short here today, about almost 20 minutes in. One thing I will point out is crude oil is still down, and again, for all the geopolitical crisis, the thing, like I've repeated for the last few weeks, is that oil was over positioned, overbought, basically in every way possible. In oil services, like all of the stocks, all the oil companies, like all of that stuff were overbought, and positioning in the futures was extremely overweight, extremely outdone or overdone. And we came down, and then of course the geopolitical tensions led to another rise, but the positioning got longer because of that. And we still are a ways away from working off that overextended positioning. So I could actually see this coming down pretty substantially over the next couple weeks, maybe a couple bucks, down to the mid 70s before it's all said and done, unless we get more geopolitical conflict. And so it's interesting because on crude oil, one of the things that you wonder is crude oil signaling that there is economic slowing and that demand is dropping? If so, then what are stocks doing? Are stocks just really excited because bonds are going up? That's pretty interesting to note. The only other thing is gold. Let's look at gold really briefly. Gold kind of sold down after an initial rise today. Gold's below $2,000. Gold's now bullish tide. We'll see what happens, but again, I don't think that there's much of a fundamental case for gold right now. If the economy is strong, as it has been, there's no reason. The only thing that's keeping gold up is the geopolitical tension, in my opinion. So if there's resolution or if things calm down, then I imagine this is going to sell down. So we'll see what happens. But right now, crude oil and gold are disagreeing with each other. So that's something to keep in mind. And then today we had a big fat sell-off on the dollar, so naturally everyone's calling for the death of the dollar, and it could be, or this could just be a correction. This is usually, again, bullish tide, but price now below the tide line. It's usually a really good spot to go long, so I will call that out as well. So anyway, we'll leave you with that for this week. I hope you guys have a good week. Be safe this weekend, and I'll see you guys next week.